Hi, in this video I'm discussing Ind As 38 related with intangible assets. The purpose of this standard is to prescribe an accounting treatment for intangible asset, to specify the criteria for recognition, measurement and disclosure relating to intangible assets.
Okay, then what you mean by intangible assets? Intangible assets are assets not having any physical substance. Therefore, they cannot be seen and touched, but they have economic value. Their value comes from the economic benefits that flow to the entity. Okay, I will tell you some examples which is not covered by this standard. For example, goodwill. That is goodwill arising from amalgamation. Its treatment is related with AS 14. So here it is not applicable. Goodwill is out of the scope of this standard. Also, goodwill arises in the case of consolidation. Its treatment is related with AS 21. Second thing, inventory. For example, if we maintain stock of intangible assets for sale as a part of ordinary course of business, we can treat it as inventory. So its treatment is related with Ind As 2. Thirdly, the standard is not applicable to deferred tax assets. And what you mean by deferred tax assets or deferred tax liabilities? Okay, in some cases there is a difference between the amount of expenses or incomes in the books of accounts and expenses or income that are allowed or disallowed as per income tax. A very common example is depreciation. For companies, depreciation rates to be considered in the books of accounts are defined in Companies Act. But while calculating income tax, the depreciation will be allowed only as per rates given in the Income Tax Act. So here, for the same assets, two methods are using for depreciation. So definitely there will be difference in values, right? For example, in financial accounting, SLM method is following for depreciation, while in income tax, WDV is following. So ultimately it will affect profit. So these things dealt with IAS 12, that is taxes on income. Okay, for our topic, this explanation is enough, but I will give you a little more explanation about what is DTA and DTL, that is deferred tax assets or deferred tax liabilities. In the above case, only income tax related to income as per books is shown as expense in the books of account, and the rest amount is shown as deferred tax asset or deferred tax liability. So what is deferred tax liability? Listen, if the income as per book is more than taxable income, then it means we paid less tax and we have to pay more tax in future, and thus it is recorded as deferred tax liabilities. Similarly, if income as per books is less than taxable income, then it means we have to pay more tax. We have paid more tax and has to pay less tax in future, so it will be a deferred tax assets. Clear? Please don't deviate from the topic. We are discussing Ind As 38, intangible assets. Now we are discussing the scope of the standard. 3 points already discussed. Now fourth one. Suppose if we given intangible assets on lease, in such situation or in such context, its treatment is related with Ind As 17 or IFRS 16. Fifth point, assets arising from employee benefits. That is, we invest some amount for, that is companies may invest some amount for payment of consideration to employees, for example gratuity, pension, salary and all those things. So the difference between the invested amount and our actual liability for payment, it is treated as an asset or liability. Okay, so these things dealt with Ind As 19 or IAS 19. Sixth point, that is, if we maintain assets for extracting minerals, oils and natural gas, it is applicable in IFRS 6 or as per Ind As 106. Some more points is there, that is, this standard is not applicable with financial assets. Its treatment is related with Ind As 32. If there is any intangible assets arise from insurance enterprises, it's not applicable here. It is dealt with in As 104, insurance contracts. Finally, Ind As 105. Ind As 105 is dealing with non-current assets held for sale and discontinued operations. So if there is any non-current intangible assets held for sale, its treatment is related with Ind As 105. Okay, then the standard is applicable to advertising expenses, training, startup cost, research and development activities, and rights under licensing agreements such as motion picture films, video recording plays, manuscripts, patent and copyrights, trademark brands, computer software, and other intangible assets which meet the definition of intangible assets as per this Ind As 38. Now let's look at the definition of intangible assets. An intangible asset is an identifiable non-monetary asset without physical substance. So in this definition, what is an asset? An asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. And we need to decide whether the entity can restrict the access of the benefits from third party or not. If the answer is yes, it is an asset to the entity and should be recorded in the entity's books. If the answer is no, it's not an asset. Okay. So, in addition to definition, we need to fulfill recognition criteria. That is recognition criteria for assets. Recognition means recording in the books of accounts, that is recording an entry. Okay, so the asset must satisfy the following two conditions to recognize it in the books of accounts. The two conditions is probable future economic benefits inflow beyond the current year. That is the first condition. Second condition, cost or value can be measured reliably. Okay, so the first condition, you see, probable future economic benefits means there must be probable future economic benefits. Probable means more likely than not. That is, informally it can be said that there are more than 50% chance. Okay, and second condition is that cost must be reliably measured. Okay, so if these two conditions fulfilled, we can record this asset in the books of account. Okay, we can split this definition into three parts. That is, first, asset is a resource. Secondly, it's controlled by the entity. How did you get? Arising from past events. Okay, then third part is expected future economic benefits or inflow for beyond the current year. So expected future economic benefits, FABs, that is the acronym for future economic benefits. It means cash or cash equivalents. How do you get this FABs? By using that asset in producing goods or providing service. You can get the FABs by sale, by exchange with another asset, or by settling a liability. Okay, so here we have intangible asset. As we told earlier, what is an intangible asset? Its definition, an intangible asset is an identifiable non-monetary asset without physical substance. So here, what you mean by identifiable? What do you mean by non-monetary asset? Okay, it is identifiable if it is separable. That is, it can be sold separately. It is identifiable if it arises from contractual or other rights. Okay. Okay, then what do you mean by non-monetary asset? So first of all, you have to understand what is monetary assets. Monetary assets are money held and assets to be received in fixed or determinable amounts of money. For example, cash in hand, cash at bank, debtors, etc. So what is non-monetary assets? It is assets other than monetary assets. These are some of the examples for intangible assets. Computer software, patents, copyrights, motion picture films, customer list, mortgage servicing rights, fishing licenses, import quotas, franchise, customer or supplier relationship, customer loyalty, market share, and market rights.